So we're doing our video for session number 5, which is on Module 7, Liabilities. Our learning objectives are first, accrued liabilities, second, short-term debt, third, the pricing of bonds, which in the book is called long-term debt, but we're primarily talking about bonds, 4, the reporting of long-term debt, again, primarily bonds, and 5, the quality of debt, looking at the differences between the rates and the quality of the repayment of the various issuers of bonds. The comic strip here is, my dad thinks I have a future in junk bonds. No, junk bonds do not correspond to junky bedrooms. We're going to look at junk being a measure of the credit worthiness, specifically not credit worthiness for institutional investors when we drop below a certain level of quality. All right, accrued liabilities. Accrued liabilities represent the balance sheet adjustments that we make so that the statements fairly present the financial condition. That's a core idea of GAAP, which is to make sure that all the revenues and the expenses are recorded. Here we're looking at the last entries typically before we close the books and go to issue financial statements. GAAP requires that any liabilities incurred during the period must be recognized in the current period. Again, we're not looking at the cash movement, we're looking at when an obligation is incurred. When do you owe money? The accrual adjustments then recognize liabilities on the balance sheet and the related expenses on the income statement that are not the result of external transactions. So normally when we receive a good like inventory, we get an accounts payable by way of an invoice. But here we can figure it out on our own. So there are two broad categories of accrued liabilities. One are those that are based on contractual obligations, contractual liabilities. But remember, these are not paid yet. That's the whole idea. Where we need an accrual is because we didn't move the cash, but we have to reflect that we owe money. So examples are wages for employees for work performed but not yet paid, interest due for the borrowed money that we have with the bank, let's say, income taxes. Once we determine our pre-tax income, we get to determine our income tax and our net income. So we have to accrue the interest tax payable based on this year's pre-tax income, and other liabilities that we may incur, such as rent or utilities and things of that sort. The second category would be accruals for contingent liabilities. Contingent means it depends. So it depends on what? It depends on whether an unknown event occurs or not, and secondly, the amount of that liability. So an example of this, the most common one, is a lawsuit, litigation. So here we may be sued and we may be fighting to defend ourselves. So we don't really know if we're going to lose the lawsuit or not. And if we lose it, what is the amount that we'll be expensing? So that's why there are uncertainties as to the occurrence and also the dollar amount. The other example are warranties. A company that manufactures hardware, let's say a car has a warranty, there will be claims that may occur for repairs covered under warranties. So again, it's a future event, broken part of a car, and the dollar amount is not certain. We don't know how much is there. So these are amounts that we're looking at there. So let's do an example of wages. Wages are not recorded because we haven't paid them yet. So we have to look back and say, do we owe people money? If so, then we would create a liability for the amount owed, and then we would also recognize the expense. That correcting entry is to increase liabilities and to increase expense. Here's an example of a transaction here in period 1, and that's the period that we're reporting, is that we have $75 that are owed to employees that were owed at year end but not yet paid. This first line right here is liabilities go up $75, our expenses go up $75, which has a negative net income effect of negative 75, retained earnings, so we're in balance. Now, in period 2, we pay our employees. You don't want to not pay employees very long. Here we reduce cash, but notice that we're reducing wages payable and not expense. The effect of this accrual entry is to recognize the expense here in the period in which it was incurred, period 1, and although we pay it in period 2, it does not have any effect on next year's income statement, which makes sense. Next, we'll look at deferred revenue. We've seen this before, but here's just another reminder that at the end of the year, deferred revenues should only be those that are not yet provided. And it's always good to look at the liability accounts and see what's in deferred revenues to see if it in fact is still deferred. Sometimes people enter the money as cash going up, deferred revenue going up, and then forget about it. They don't check to see if the revenue's been earned. An example here where that may occur would be like prepaid license fees for Microsoft. If Microsoft charges, say, $1,000 for 1 year of use of a program, it records the initial cash payment as cash goes up and deferred revenue goes up. Well, they may not get around to recording every single month for the revenues. There would be an adjustment necessary to look at what is in the deferred revenue account and how much should have been recorded this year. That would be an adjusting entry, reducing deferred revenue and increasing revenue in this case. How do we look at contingent liabilities? So first, as mentioned, they're contingent upon a future event. We must record an accrual if two conditions are met. If either are not met, we do not record it. The conditions are, it's probable that the event will occur. Back in our litigation example, it's probable that we will lose this court case. Secondly, we can reasonably determine the amount of the charge. We can estimate the total amount that we will lose for the lawsuit. That's under the example of a lawsuit situation. When we go to the liabilities from a warranty, it's probable that we will have some warranty claims, and we can estimate based on prior year's history of what those might be. We would then, in that case, it would meet the two tests of probable and estimable, and we would record an estimated warranty expense. You can see that contingent liabilities cover a broad range of things, including lawsuits and warranties. And in both cases, we could see if the two conditions are met. And if so, we recognize, actually, it's not a choice, we must recognize under GAAP the expense and also create a liability, which is essentially a reserve that we will then draw upon when and if those things do occur. Let's do an example of a warranty. These are commitments for extended warranties or after the purchase, post-purchase warranties. They're for a period of time, 1 year, 2 years, etc. And it's for the repair or replacement of that item if it should break. These meet the two tests, and if so, we would record it. Here on this first row, we recognize that in this period, we will have an estimated $1,000 of expense from the warranty claims. So we put that there. And the second row here represents what happens when we pay the claim. Well, in this case, we pay the claim by replacing the defective part with a new part. So we would reduce inventory, but rather have it be an expense, say warranty expense, it is charged to a payable. This is a common mistake that students make, is that when we either pay cash or give a perfectly good piece of inventory to satisfy a warranty claim, it's an expense. But do not charge expense when we kind of honor the claim. The expense was recorded when we established the reserve. Very similar to what we're doing in accounts receivable. When we provide for an allowance for doubtful accounts, when we have a bad debt occur, do not charge bad debt expense. Instead, charge that reserve. Same thing. All right, when we look at the footnote from Harley-Davidson, we see the following schedule. This shows 3 years, 2013, 14, 15. We're going to focus on 2015, what's happening there. The first row is the start of the year. We started the year with $69 million in this reserve for warranties and recalls. The next three represent what happens during the year of 2015. Well, we had some warranties because we sold more motorcycles and other products, so we have to add to this reserve and charge expense. The next row is settlements made during the period. These are a negative number, $98 million. We settled. Settle could be a replacement or it could be repair of a defective product. The next row are recalls and charges based on the warranties, and this is $42 million that we would estimate that we'll have to pay additional expense due to these pre-existing warranties. And then this net number, the $74 million, is the end of year balance. This is a fairly common type of statement where it starts with beginning balance, then the changes during the year, ending with an ending balance. A couple of notes here is first that only the increases in liabilities are charged to expense. In this case, the $59 for a current year product sold and the $42 million for an estimate based on some pre-existing warranties that we need to cover. When we analyze the warranty disclosures, it's pretty difficult actually without a lot of knowledge. We know what it's supposed to be. It's supposed to be their estimate of what the charges will be. But we know that it's tempting for companies to play around with this and to essentially manage income. If they underestimate a warranty liability, then they're going to be showing more income on their net income. If they overestimate the amount of expected future claims, they're going to lower the net income because they've boosted up their warranty expense. So we call this a cookie jar reserve. It's like putting cookies in a cookie jar, and later on you open the lid and take some cookies out. So that's what we call this. It's a way to manage income. It's not really an ethical position. We're supposed to be reporting within what we believe to be accurate information. GAAP, as we mentioned, gives you guidelines within a certain range, and CFOs become quite adept at managing within the allowable range. This net effect is that it gives some latitude to companies to manage their reported income from year to year. When we look at the statements in the context of not only income statement but the notes, we may be able to form an opinion on whether there is some kind of manipulation going on in the reserves for the purpose of managing income. But again, it's a difficult thing to know because you're questioning the judgment of the company.